Global share markets have plunged on growing fears that heavily indebted countries in Europe, including Greece and Portugal, may default on their repayments. Continuing high unemployment in the United States added to the woes, while here more than $30 billion was wiped from the market. Investors wondering if they've been too optimistic about the pace of global recovery.
After a bad January, early February has turned in a shocker, read across the boards of the stock exchange in a knee-jerk response to diving overseas markets.
We saw a big plunge of more than 2.5% right when the market opened. The mining players, not surprisingly, are the biggest drag. We saw investors really bail out of commodity prices overnight. They're really trying to stay away from risky assets at the moment.
The Australian dollar shed 2 US cents overnight amid global risk aversion.
Global growth is fragile. Global growth at the moment is largely supported by stimulus.
It's the downside of stimulus, a blowout in public debt that's behind the fresh market jitters. Top concern that Greece may default. Unions now mobilising against an austerity program to cut a deficit now worth 12% of GDP. Australia's is 4%. And it's feared that Greece was just the early warning, as governments that borrowed record amounts last year to stimulate their economies out of recession now can't repay. Perhaps the next flashpoints, Portugal and Spain, saw their equities slump more than 5% overnight.
It's a reminder that the world's governments are sort of running out of ammunition to support growth, that it can't be done on borrowed money without consequences eventually.
Wall Street tumbled 3%, dismayed too by a rise in first-time jobless claims, pointing to continued high US unemployment.
The biggest fear right now is it's kind of two things. One is unemployment, and two is how long is this recovery going to take?
The panic sell-off spread to Asia, while our market closed down 2.4%. Some pundits, though, not too fazed.
In the longer term, really, we don't think that this is anything for investors to be too worried about. And in fact, today is really just a great opportunity for people to get into the market and use it as a buying opportunity.
The wild market swings overshadowed another upbeat quarterly outlook from the Reserve Bank. Its previous forecast of 3.25% GDP growth this year stays, but the forecast for next year rises slightly to 3.5%. Unemployment, it believes, has already peaked. As improvements there drive up wages, underlying inflation's now seen as reaching 2.75% by 2012. The clear signal, interest rates, steady on Tuesday, will rise again. The opposition again prodding the government on stimulus.
Stop spending so much money. Interest rates will rise.
After today's market ructions, though, the timing of any rise may be even more doubtful. Rena Saran-Pyatt, World News, Australia.
Well, checking the damage now, and with that dumping of our stocks, our market slumped to a 3-month low. It's now fallen for 4 straight weeks, its worst run since mid-2008. 44 of the top 50 shares fell, led, as we've seen, by the big miners. Major lenders also took a hit, along with Westfield, the day's worst performer. Tokyo's Nikkei tumbled, ending at its lowest level in almost 2 months. Wall Street, the Dow briefly fell below 10,000 points in the final minutes of trade. Our dollar is now buying 86 US cents, and it's also down against the other major currencies. Amid the commodity sell-off, gold's taken its biggest tumble in more than a year, and oil is also lower.